Hi everyone, my name is Elliot Gu, co-founder and chief analyst for Scoop Premium. I'd like to thank you for signing up for our Scoop VIP program. Today I want to talk to you a little bit about a crucial concept for anyone interested in the health of the broader stock market or anyone looking for an early warning signal ahead of a major stock market sell-off. It's a simple yet powerful indicator I've used for years, and if you have an internet connection and a computer, you can actually follow it for free. As a matter of full disclosure, I should tell you this indicator is absolutely nothing new. Like so many other useful patterns in the financial markets, it has stood the test of time. Let me give you an example, actually from a little over a century ago. Many of you may be familiar with a book called Reminiscences of a Stock Operator. This is my copy. It was first published in 1923 by a man named Edwin Lefebvre, who was a writer for the Wall Street Journal. If you aren't familiar with it, you can buy it on Amazon for about $16, and it is a true investment classic that's well worth reading. It's actually a thinly fictionalized biography of a real market trader named Jesse Livermore, with whom Lefebvre conducted a series of interviews. Livermore became one of the most famous stock traders and speculators of all time, and he was known as the boy plunger due to his habit of plunging, which is an early 20th century term that refers to making large bets on stocks to decline in value. He was already a rich man in 1923 when this book was published, but he's probably most famous for betting on the stock market to fall in the late 1920s, just before the 1929 Great Crash. Following the 1929 crash, his net worth was estimated at $100 million, and that is in 1929 dollars. That's actually worth around $1.5 billion in today's money. At any rate, Livermore's success calling key market tops makes him an important person to study if you're looking for signs that the stock market is topping out. Livermore had this to say about market tops, specifically the 1916 market top and the ensuing bear market, which saw the Dow Industrials plummet about 40% from a high in November 1916 to a low in December 1917. And Livermore said this, and I quote, and this comes from the book: "A market does not culminate in one grand blaze of glory. Neither does it end with a sudden reversal of form. A market can and does often cease to be a bull market long before prices generally begin to break. My long expected warning came to me when I noticed that one after another, those stocks which had been leaders of the bull market reacted several points from the top, and for the first time in many months, did not come back. Their race was evidently run, and that clearly necessitated a change in my trading tactics." In other words, Livermore had been a bull for much of 1916, but began to notice some previous market leaders lose steam in 1916. And as more and more stocks began to weaken, even as the broader market marched higher in late 1916, that told him that the bull market was nearing an end. This basic idea is called market breadth. Follow this indicator if you want to squeeze as much upside as possible from the current ongoing stock market rally, yet avoid the major pain associated with the coming bull market top and of course the ensuing bear market. Let me explain. Most of the major market indices are weighted by market capitalization, market cap. Let me put up a chart on the screen here to illustrate. So this chart shows the breakdown of stock weightings in the S&P 500. As you can see, the 10 largest stocks in the S&P account for about 23.5% of the total index. The 20 largest stocks in the S&P account for nearly 1/3 of the S&P 500's movements. And the top 100 are 2/3 of the index. So let me ask you this. What about the other 400 stocks in the S&P 500? The truth is that these other index components just don't matter that much to the S&P. The largest stocks in the index drive the S&P. So let's flip over and look at the Nasdaq composite. Okay, so there are over 2,550 stocks in the Nasdaq right now, which might actually make it seem like a fairly broad-based index, right? But here's the thing, most of those stocks just don't matter. In fact, the Nasdaq is even less broad-based than the S&P 500. Just the 10 largest Nasdaq stocks, which includes names like Apple, Alphabet, which is the old Google, Amazon, Microsoft, and Facebook, account for just over 40% of the Nasdaq composite. That's 10 stocks, 40% of the index. And the 2,400 smallest stocks in the Nasdaq composite, which is really more than 98% of all the stocks in the index, all those stocks together account for just 21% of the index. So that's barely half the weight of just the 10 largest stocks, and that's 2,400 stocks. So my point is that if you're just following the S&P 500 or the Nasdaq, you're going to miss a lot of what's going on with these other stocks in the market. You're just focusing on just a few of the largest names. The important question to ask is not just if the market is going up as a whole, but if the market advance is supported by most stocks or just a handful of larger names. I look at a number of different indicators to assess this, but let me show you just one of my favorites. Here's the cumulative advanced decline line for the New York Stock Exchange, and this is only looking at stocks traded on the New York Stock Exchange, not exchange-traded funds or ETFs or closed-end funds. So this is just a running tally of the total number of stocks traded on NYSE that are going up in price on a given trading day, minus the total number of stocks declining in price. So when the line is rising, it means that most stocks in the NYSE are rising in price. This is bullish and suggests a broad-based market rally. In contrast, when this line is falling, more stocks are falling in price than rising, and that's basically bearish. But what I really look for in particular is what are known as divergences. Okay, this is situations where the market is rising, but the advanced decline line is not rising to new highs. This chart from 2007 and 2008 shows one example, a classic example of this. And here you can see the S&P 500 logged a fresh all-time high in June 2007. And if we flip over here, you can see the NYSE advanced decline line also logged a new high. So no divergence there. The rally was still pretty broad-based in June of 2007. However, the market pulled back in the summer of 2007, found a low in August, and then ran up to a fresh all-time high in October. A fresh all-time high for the S&P 500, of course, at that time. However, on this rally, the advanced decline line did not follow suit. It did not break out to a new high, even as the market broke to a new high in October. Instead, the advanced decline line showed a lower high when the market hit its bull market top in October 2007. Because the August to October rally for the S&P 500 was pretty thin. It was supported by only a small number of large cap stocks. Then, you can see here, right, the advanced decline line continued to deteriorate into early 2008. And that was a sign we'd entered a bear market. And this turned out to be a doozy of a bear market, of course, with the S&P 500 ultimately falling more than 50% to a low in early 2009. Okay, and here's another example, and this one is not a bear market, but it is a major correction just a couple of years ago in 2015 and 2016. Okay, do you see how the cumulative advanced decline line steadily deteriorates starting in the spring of 2015 at this May highs for the advanced decline line? Well, the market basically held up until August of 2015, the market itself, even as the advanced decline line deteriorated. However, deteriorating advanced decline line signaled underlying weakness in the market and led to a series of nasty sell-offs between August 2015 and February 2016. The U.S. bull market, and here's my point, the U.S. bull market that started in March 2009, it's already 9 years old and one of the longest in history. So we believe prudent investors will be looking for signs it may be about to end because avoiding bear markets or potentially even profiting during bear markets is absolutely crucial to long-term investing success. And the passive indexing type strategies that work so well in a bull market year like 2017, like last year, are going to get hardest hit when the market takes a turn for the worse. Of course, no indicator is perfect, including this indicator of market breadth. However, we believe adding this one simple indicator, and as I said, you can find charts of breadths on the internet for free, chart of market breadth and the cumulative advanced decline line on the internet for free. Just adding this one simple indicator to your toolbox can potentially save you a ton of cash in coming years and maybe even help you make a little bit of money when the market does turn lower. And that is how you're going to outperform the market over the long haul. Watch your email inbox because shortly I'll be sending you another video like this about one of my favorite market sectors to buy right now, including one of my current top stock recommendations to buy now and one that I would recommend avoiding like the plague. Trust me, you do not want to miss this, so keep an eye on your inbox, and thanks again for watching this today.